month of March was defined by the banks. Silicon Valley Bank, Signature Bank, First Republic, Credit Suisse, all had their own individual type of failure. Now, some of this was mismanagement of money. Some of this was top-down decisions that weren't phenomenal. But a lot of this has to stem from where interest rates were and where they are now, and how fast that has happened. The first bank we'll start with is Silicon Valley Bank. Bad management decisions, bad investments, terrible clientele for a bank run. So the house wasn't necessarily on fire, but as everybody was exiting, somebody kicked over a candle and the place went up in flames. The main reason was during this bank run, the Silicon Valley Bank had to sell some of its terrible treasury bonds that they were essentially forced to buy throughout these past couple of years, and that sunk them by billions of dollars. Signature Bank, similar story, similar clientele. However, they were the third largest bank failure as opposed to Silicon Valley Bank's second largest bank failure in U.S. history. First Republic bailed out by 11 other U.S. banks for $30 billion in deposits. And then Credit Suisse, across the seas, bought up by UBS because of its failures within the banking industry. Now, Credit Suisse had some prior problems from prior years, and this was just kind of icing on the cake. Now, these bank failures aren't necessarily a problem. A lot of our larger U.S. banks are doing just fine. Your JP Morgans, your Wells Fargo, they're all doing fine. The problems that might occur are extra regulation going forward. Maybe you don't trust those regional banks. Like, those are very necessary for our economy and our various industries. And there is now a threat that they might go away because of FDIC insurance. Money flowed out of banks and into things like treasuries, gold, silver, and Bitcoin. Some practical applications are to hold more money at home out of the banks. Buy some gold, buy some silver, think about Bitcoin. That's a whole nother conversation. Look at treasuries, especially right now with inverted yield curve. That money, short-term money, will make you more than long-term money. Looking forward, the Fed's interest rate decision just got a heck of a lot harder. It was commonplace that they would raise rates a couple more times, then hold steady. Now it seems more likely that they will hold steady for possibly the rest of this year. However, the market is still pricing in a drop of interest rates, which this firm doesn't necessarily agree with for right now. Amidst all this, we're up on the month. So the Dow adds 1.9%, the NASDAQ up 6.7% on the month, and the S&P 500 up 3.5%. Here are your year-to-dates. In a grander overview, continue to put into your 401ks, continue to put into your IRAs, continue to put in your taxable. We're at a bit of a precipice where things might go up, things might go down. It is our firm's stance that there still needs to be a little bit of down, if not a fair amount of down, to have a healthier economy. If things happen to swing up, let's not get wrapped up in it. Let's not chase after it. And let's just continue our every month steady putting in until we are a bit more confident in what's going on in our economy, what's going on in the US, what's going on in the market. I know that this was a bit longer of a video, but I wanted to make sure that I touched on as many things as I possibly can. I wish you guys the best, and I look forward to seeing you in April.